perspective. With that, let me toss it to our experts to further decode the policy for us. Neeraj Gambhir, Group Executive and Head of Treasury and Markets and Wholesale Banking Products at Axis Bank is with us, as is Soumya Ghosh, the Group Chief Economic Advisor at State Bank of India, Pranjul Bhandari, Chief India Economist at HSBC, and Rikin, Shah, Vice President of IIFL Securities, all with us. Pranjul, gentlemen, thank you very much for your time here. Pranjul, quickly, any additional takeaways from this press conference? Is your base case also a potential rate cut in February, given the current forecast of 4% only by the second quarter of next year in inflation?
Yes, thank you very much. Good to be here. So, look, I think a great balance was sought today. You know, the RBI gave that rate cut, the CRR cut because of growth concerns, but did not give you the repo rate cut because inflation is still very high and it's prudent. You have to, take timely steps. Our sense is, yes, that in February we will see a repo rate cut. We do agree with RBI that growth will rise by then, inflation will fall, but we don't think the quantum will be as encouraging as RBI is thinking. We think we will see some rebound in growth, but not very much. For example, RBI is thinking in second half of the year, growth will average 7%. We think it will be closer to 6.5%. Tax revenue growth has slowed. We don't think the government can spend very much at this point. Winter has come in a bit late, so some of the agriculture produce may also not come on time. So we may not see rural demand also pick up very quickly. So we don't think growth will be that strong, and there will be pressure on RBI to act. In terms of inflation, again, we do think it will come down, but it may not come down as quickly as RBI is expecting it to. So given all of this, our sense is that yes, there will be repo rate cuts, and we are expecting one in February and April, but we think it will be a shallow rate cutting cycle of about 50 basis points. That's it. If anything more is needed, it's going to happen via liquidity. Today was the start, and I think over the next year, we'll see all kinds of liquidity instruments being deployed, from OMO purchases to longer tenor FX swaps, and so on and so forth. So, just to cut a long story short, agree with RBI on many things, but we do think that growth will remain a problem for longer, and monetary policy will have to remain more accommodative for longer, maybe not by too many repo rate cuts, but a lot more liquidity.
So that growth inflation unsettled balance probably will remain so for a while. Pranjul, thanks very much for that opening remark. Mr. Soumya Ghosh, on the growth numbers itself, RBI has brought down 7.2% for the year to 6.6%. But are you aligned with the kind of numbers they've given for the second half of the year? 6.8% for the third quarter and 7.2% for the fourth quarter. Mr. Soumya Ghosh.
Yeah, thank you, Ritu. I think regarding the growth numbers, I'll just want to put some estimates back on the table, because if you look at the RBI monetary policy statements of the last couple of years, there is always a growth revision in October compared to August, because then the RBI has a fair amount of idea of what the growth is going to look about. But it was the first time in several years that the growth forecast was actually upgraded to 7.2%. If you look into FY 23 and 22, there was a 100 to 80 basis point downward revision in the RBI growth forecast, which later on actually turned out to be correct. So, and this time the RBI actually upgraded in October. Now we have downgraded to 6.6%. My sense is that yes, there will be a recovery in growth, but the growth numbers is not going to be as strong as the central bank is expecting. I think a number which could be closer to the 6 to 6.3% handle would likely turn out to be the final number, because as of now, yes, the RBI also has said it clearly in the press conference that urban demand is actually not holding up, even though rural is holding out. And our sense is that given the fact that liquidity is going to be a long-standing issue, so the CRR cut is welcome for the banking system. But in terms of the growth numbers, we are not as much hopeful about a 6.6% growth rate this year. So growth is likely to surprise on the downside. And on the inflation numbers also, I think it will take little while to come down from the levels, because it has been continued to be sticky for the last several months and years, and it is unlikely to come back in a jiffy. So overall, it's a good policy, but I think on the expectations from the numbers are unlikely to be like that as part of the forecast.
Okay, Neeraj Gambhir, what's your sense? The numbers, do they look credible? Are you expecting a risk upside or downside on both CPI and GDP? And with the CRR cut of 4%, what next? What is your base case?
So, first of all, I think I found the opening remarks of the governor quite interesting and useful to think about. He's kind of, even though we have an explicit inflation target in the law, he's kind of brought some kind of balance back into our, RBI's own thinking in terms of the relative importance of growth versus inflation. Secondly, as most of your other commentators have said, that growth projections of RBI seem to be a bit optimistic, and we don't expect that to be realized. So that, in my mind, kind of sets the bar a bit lower in terms of a future interest rate cut, if the growth projections were not to materialize. So I think, yes, the possibility of a February rate cut remains alive. Key data point will be growth. Even if there is a bit of upside surprise to inflation compared to RBI's forecast, I think the focus towards growth is something that we will see in future RBI actions. I do agree that liquidity remains the biggest issue for the markets, even though this time we've seen a CRR cut, and this should inject a fairly good amount of liquidity in the system, given the pressure on the currency and given the fact that the government spending is something which is kind of quite back-ended. I think there is going to be a need for providing continuous liquidity into the system and making sure that the overnight rates, etc., are well anchored. My final point is that while we have seen a CRR action at this point in time, there is a wedge in the market in the sense that the short-term money market rates are actually quite elevated, despite the fact that the next possible action from Reserve Bank is likely to be a rate cut. That kind of creates an issue where the bank's funding cost is quite high. So I'm hoping that this CRR cut will actually help us bring the spread between overnight rate and, say, for example, CD rates and bulk rates somewhat lower. And that should help, in some senses, the system. But if that were not to materialize, more liquidity actions will be required.
But Mr. Neeraj Gambhir, you expect that on the liability side, deposit rates have peaked. Some of the pressure will come off with this 1.16 lakh crores coming into the system?
So we are in a situation right now where the CD rates and the bulk deposit rates have actually sustained at a far higher level as compared to retail deposit rates. The retail deposit rates have been in this range for quite a while now, but we are seeing, periodic pressure on the bulk deposit rates, coming and going, particularly towards the quarter ends. I'm hoping that with this action, some of that will be sort of alleviated. We ideally, as a first step, we should see a better convergence between bulk deposit rates and the retail deposit rates. I do not expect banks to be raising their retail deposit rates at this stage, when the next step from Reserve Bank is likely to be a rate cut, and the central bank is quite committed to providing liquidity into the system.
Okay. Rikin, again, what is the base case that you're working with? And going ahead incrementally, what do you expect to see on the liquidity front after this 50 basis point CRR cut that has been delivered?
Sure. Good afternoon, Ritu. So we were expecting a 50 basis point of CRR cut in this announcement. Repo rate, as most of the commentators have commented, and our house view has been that it could earliest be in Feb or maybe in April. In terms of the impact for the banking sector per se, the typical sensitivity suggests a margin uptick of 4 to 5 basis points for most of the banks, and ROA uptick of 1 to 2 basis points. But that implicitly assumes that the funds which have been freed up due to the CRR cut will be deployed to the loans, which may not happen for all the banks. Given the LDR and LCR constraints which many banks are grappling with, we believe that it's mainly the PSU banks and select private banks who can see this entire flow through into the NIM impact. The second order impact of the CRR for most of the banking sector would be in terms of some easing in the deposit rates. If I look at the peak retail time deposit rates offered by banks in 1 to 3 year bucket, from September onwards to now, they have kind of softened by 10 to 15 bits for select PSU banks, and the bulk deposit rates they have also come off by 5-10 bits, but they still remain very elevated, as Neeraj also pointed out. So net-net, CRR cut is a welcome move for the banks, and the pushing out of repo rate cut also should support their margins in the fourth quarter fiscal FY25.
Okay, Soumya, Kanti, Ghosh, some of the other non-policy measures, including the collateral-free agriculture loans, the limit being enhanced by about 20,000 rupees per borrower. Are these incremental measures going to move the needle? When we talk about credit growth pickup in the system with the additional liquidity inflow from the CRR cut?
No, I think, Ritu, I think that agricultural credit from 1.6 to 2 lakhs is a very welcome measure. In fact, if you look into the data which is there in public domain, more than 95% of the records, land records are now digitized across states. I think this number was at 95%. It has marked that move significantly higher. So the banks have been actually asking for an increase in this collateral free limit because now that the land records are digitized, so it will be easy and an operationally easy part on the banks to extend high value loans to the small and marginal farmers. So the banks have been actually asking for this limit to be raised to 3 lakhs. Possibly the RBI may do it in a graded fashion, but I think it's a welcome move in terms of credit growth to the small and the marginal farmers. But on the larger question of liquidity, I just want to add one point. I think the villain in the room is the government cash balances, which has been fluctuating from this end to that end over the last 2 to 3 months. And the main issue is that the government has migrating the entire payment system to the just in time. So this means that an additional 7.5 trillion of overall government program will move into this JIT over the span of next 3 to 4 years. So if this is going to happen, so this will be the biggest elephant in the room. And you know that this is mostly this government cash balances is frictional in nature. So all these balances have actually moved outside the banking system to the e-cubed. And that is creating this imbalance. So from that point of view, this permanent liquidity injection on the part of the CRR is going to be welcome. But maybe on the liquidity, some more has to be done as we progress in the next year or so.
And what more could that be? Are you expecting, apart from VRR, perhaps some OMO purchases? What more are you expecting from the RBI in terms of the tools that they could use?
I think right now the argument was that a temporary liquidity withdrawals could only be made by temporary liquidity injection. But as you have seen to the CRR is actually a permanent liquidity injection. So that's basically an acknowledgement that liquidity is going to be tight over the next couple of months. I think apart from that, one of the steps which the Reserve Bank has done today is cutting CRR headline. I think on product specific, CRR could also be cut of some of the deposits, which could also add a significant enabler to the banking system. And OMO could be another potent tool at a later point of time. There is enough pressure on the exchange rate once the new US president takes over. So there has to be on the table several liquidity enhancing measures. CRR could be one of them at this point of time.
Okay, Pranjul, you said you're expecting a shallow rate cut cycle of about 50 basis points. What are some of the risks you see to this? And you're, in terms of the next steps, you're expecting a change in stance to accommodative and a cut by February. That is your case?
Well, not a change in stance. I think there's really no need to change from neutral at a time. Then there are going to be so many global uncertainties. And neutral basically includes everything. You can be hawkish, you can be dovish, depending the flavor of the day. So I don't think the neutral stance will be changed. But within this neutral stance, I do think that we have space for 2 rate cuts. At this point, I'm hoping for for February and then April. But there are risks, that they don't happen in that timeline, that they get delayed. And I think a lot will depend on the US dollar. If we start a world in 2025 where the dollar is extremely strong, maybe, in January, early Feb, dollar has strengthened even more, then my sense is we may actually wait and watch and not give that rate cut. Nothing can be said for certain in such a sort of a globally uncertain world. But if dollar behaves itself, if it's broadly stable, then I would go ahead and say that, the first rate cut, repo rate cut will happen in February. The other thing that I feel, we should take for granted is disinflation. Food prices, we all are hoping falls, and we all are hoping that we see the winter disinflation. But there have been a couple of problems this year. One, the winter onset has been a bit delayed, because of which sowing has been a little bit delayed. And 2, there has been some shortages of certain fertilizers impacting wheat and potato. So my sense is that if weather doesn't hold up in the next couple of weeks, then we can't take the disinflation for granted as well, despite having strong reservoir levels at this point of time. So there are many questions out there. But yes, my base case right now is that the first rate cut is going to happen in February and then the next one in April. Beyond that, it's going to be liquidity, as everybody else has also been pointing out. that will really do the work of supporting GDP growth.
Okay, Mr. Neeraj Gambhir, what is your base case? What will be the total quantum of rate cuts in the cycle? And what are the key risks to this growth and inflation dynamic?
So I think as far as the base case for February is concerned, I would say that February is live. I wouldn't want to put a probability on it as yet because we need to see both the growth and inflation data play out over the next several weeks to see what happens. Pranjul has very rightly pointed out the global aspect of it in terms of dollar strength and the pressure on EM currencies. So I would say, yes, February is live, but very hard to take a call on what the probabilities are. I do feel that there is not a big case for making large rate cuts at this point in time. So I would feel that Reserve Bank will actually wait and watch out to see the data before taking each rate cut call. So it's a call in itself. So I don't think that if February is done, then April is automatic. It's pretty much that you take one step and then you wait for things to play out over a period of time. One thing that I wanted to call out was that we have seen a kind of wedge between the growth of deposit rates and the lending rates, the lending growth kind of narrow down. The advances growth and deposit growth is now pretty much close to each other, but that has happened largely because the banks have curtailed their lending. So effectively, while the deposit growth has not picked up, the lending growth has actually tapered down. One of the reasons why deposit growth has not picked up is because liquidity in the system was tight and there wasn't as much primary liquidity creation in the system. I'm hoping that with this CRR cut, we'll once again start the process of primary liquidity creation in the system. And if that process is sustained, we should see some benefit to the overall deposit growth in the system. And that's one thing which is absolutely important for us to make sure that growth holds up. The reason for growth slowdown is also the fact that the credit impulse in the economy has turned negative over the last several months.
Okay, Rikin, what is your expectation in terms of the impact on banks? Largely our panelists have been telling us about 2 to 5 basis point improvement in margins. What about the NII front for some of the large banks in the system?
So yes, I would agree that the NIM impact should be 3 to 5 basis point and the PAT impact should be around 1%. But as I earlier pointed out, that may not necessarily flow through for all the banks. The banks who have lower LDR and higher LCR will be able to deploy this freed liquidity to loans. Others will put to some other uses. So that's the financial impact of the CRR cut. And one more additional point which I wanted to call out was the governor increasing the ceiling rate on FCNRB deposits. Yes. And what we have seen is that while the SOFR rate is around 4.6% and the existing spreads were 250 basis points on top of this, most of the banks were already offering rates much below the current ceiling in the range of 4.8 to 6%. So the further increase in the ceiling may not necessarily result in higher mobilization of FCNRB deposits. Perhaps any CRR exemption for this deposits could have spurred some growth in that, but otherwise they should largely be a non-event kind of a thing for FCNRB deposits for the banks.
Okay, that's an interesting view. Mr. Soumya Kanti Ghosh, you think this FCNR deposit, ceiling being raised to ARR plus 400 to 500 basis points, depending on the maturity, this will not make the deposits that much more attractive? Will it not really move the needle?
I think so. I think this was exactly the same thing which we have been propounding in the policy, run-up to the policy, that there should be a CRR cut on specific liability products. And NRE deposits, NRO deposits, FCNRB was one of them. I don't think that giving this leeway on terms of the interest rate is going to help them, because that is, as my co-panelist said, that is being unutilized. And perhaps I think taking a cue, and this has been done in the past also in the 1990s, to give an encouragement to capital flows. I think a CRR cut on this product would have been more useful. So that's why I have been saying that maybe in terms of an headline CRR impact, there could be more micro-specific CRR impact on liabilities and products. And that could actually have a more meaningful impact on the liquidity in the system. So I think, so this is a good signaling, but I don't think it is going to help in any way in terms of the capital inflows.
And just to remind our viewers, the relaxation is only until March. So this is a 3.5-month window during which banks can offer these higher rates. Gentlemen, thank you very much for being with us, all of you. Mr. Soumya Kanti Ghosh, Pranjul, Rikin, Mr. Neeraj Gambhir. Thank you for sharing those thoughts. Pranjul, before we let everyone go, any closing comments on any other highlights? Do you think any reading between the lines that you want to highlight for us from the press conference or from the governor's statement that we haven't discussed so far?
Well, I think the one thing that sort of keeps coming up, every meeting is the way RBI is focused on inflation targeting. Despite commentaries from government or from like market participants, I think it's really focused on seeing this whole food disinflation and coming closer to 4%, maybe not exactly at 4%, but definitely, lower than 5%. And I think that today what it showed was even if sort of growth disappoints, they're not going to take any knee-jerk reactions. And I think this sort of firm belief that they're an inflation targeter and that's their primary objective and everything else is slightly secondary, I think sort of stood out quite a bit for me today.
All right. On that note, Pranjul, gentlemen, thank you very much for your time and for helping us parse through this policy. And we will continue that discussion, with other guests that are